to my entry to exit masterclass. This will be a 3-part class full of examples, how to get in and get out of a trade, starting with a review of the principles. The principles are the key. There are 3 tools or principles that I've used throughout my 35-plus year career. I've honed these down to what I believe is the best system or strategy that can be used in any market. 3 principles are the regression channel, the measured moves, and the Fibonacci extensions. This system is laser focused to unlock profits in any market. It's a simple strategy. It's something that you can do all the time in any market. The first part, we're going to be talking about the 3 principles, which is a review from the guide, some recent trades, and my rules for success. In part 2, we're going to be going over how to set up the charts. I use Thinkorswim as my trading platform, so what I'm going to show you is how to set up the charts on Thinkorswim. If you have another trading platform, it's probably very similar, and if you have problems, you can probably always go to their email for help or their 800 number for help. Going to be talking about the trading vehicle and what's the trading time frames for the different markets that I find is the best for trading and getting maximum profitability. Part 3 is very exciting. That's where we put it all together, and I show you how to find a trade, how to enter a trade, and then how to either exit a trade with a profit or a loss. So the micro overview again is the 3 principles, the power of this method, the pivotal concepts for trading success, and then some recently executed profitable trades and one losing trade and how we got out of that. So let's quick review the 3 principles. 3 principles, again, are the regression channels, measured moves, and Fibonacci extension. I use the regression channel to enter a trade. I use measure moves to manage the trade and look forward to where I should exit the trade, either with a profit or a loss. Principle number 1 is the regression channel. I've been using this for my 35-plus year career. I used to calculate the regression channel by hand. Nowadays, on any of the more popular trading platforms, this can be calculated for you automatically, which is quite an interesting feature. First of all, the regression line is calculated by 50% of the price action below, 50% of the price action above. So it creates a middle line, which is called the regression line, that shows basically the trend with 50% of the price above and 50% below. This is a 1-year daily chart of Google where I've put in the regression line. And once again, you can see how 50% is above and 50% is below. And Google over the last year has had a positive trend. Not a great big one, but a positive trend. Now, once we have the trend line or the regression line established, we can apply some statistics to that. And I can go out to the first standard deviation, either the plus or the minus. And statistically, what that means is that 68.2% of the price will be contained within the plus or minus 1 standard deviation. Here you can see I've applied this again to Google. These are the green lines. There's +1, -1. And for most stocks, the +1, -1, can show you pretty close when it's time to get into a trade, when it's time to get out of a trade. But when I apply the +2 and -2, now all of a sudden I've got 95.4% of the price action contained within these channels. This is kind of like the casing on a sausage, and all the meat is contained within. Now, occasionally we do get outliers, and they go outside here, but they revert back to the mean very quickly. So if we do have an outlier, you got a pretty high probability trade that it's going to be reverting back. A lot of people look at this and say, well, is this contrarian trading? It really is not. What it is, it's taken advantage of the price action that you see and putting it within some boundaries so you can see when things are overbought and oversold. And that gives you a little clearer picture of when to trade, when to get out, when to get in, when to get out, get in some more, and get out. It's a little easier to visualize how you should trade this when you have the regression channel in place. And it can be used once again in all the markets. We looked at a stock right before. Let's just take a look at the ETF of the Standard & Poor's 500, the SPY. And you can see it came down to the -2, good time to get in. +2, good time to get out or buy a put. Good time to get in, another good time to get in, and so forth. So in conclusion, the regression channels are statistically the best way to enter overbought and oversold markets. Our second principle is using measured moves. Measured moves really show you where the trend is going. Measured move is when you have the price going up and it pulls back and then continues on. It has made a higher low and then a higher high. This is true if it's going down. You can see it go down, it pulls back, and then it continues on. It makes a lower high and a lower low. These are the classic definitions of an uptrend using the bullish measured move, higher highs and higher lows, or a downtrend using the bearish measured move, where you have lower lows and lower highs. Here's measured moves applied to our Google trade with the regression channel on there. And now we're really starting to focus in on when a trade can be made and how long we can stay in it. You can see how it stair steps down, and then it makes a major move to the upside, another one, and another one. And you just continue on with that uptrend. Let's take a look at the SPY and see if you can see the same thing. Absolutely. Here's a major move to the upside. Here's one to the downside, a continuation to the downside, a revert back. So there's a lot of information with the measured moves. They are the best way to quantify a trend once you're in a trade. Now, the other nice thing about the measured move is once you have that, you can apply Fibonacci extensions automatically to your charts. Once you have the measured move, you can come in and click at A, drag to B, drag to C, and you get the Fibonacci extensions, the 127, the 161, the 261. 68% of the time it's going to reach the 127. These Fibonacci extensions are all come from the Fibonacci root ratio, which is seen throughout nature. So doesn't it make sense that the Fibonacci extensions hold true in the market, because fear and greed are very much human nature. Now, here's our Google with some Fibonacci extensions. Here's the measured move, comes to the 127. What a great point to take profits. Then we have a measured move to the upside, 127, great point to take profits. Second measure move, 127, great point. Third measure move, 127. This one actually went up to the 161. Let's take a look at our SPY. Here's the first measured move, takes it to the 161. Then a bigger measured move, this big measured move takes it to the 127. You know, the more I use these, the more uncanny I see that the Fibonacci extensions, I mean, sometimes they hit it within a tick. And it could be roaring down like a locomotive, and it hits that Fibonacci extension and it turns on a dime. Here's a measured move going down that blows right through the 127, right through the 161, all the way to the 261. Here's a measured move to the 161, another one down here to the 261, and so on. The Fibonacci extensions allow me and you to preset price targets for an exit, and that is a very powerful tool. Because we know when the measure move goes against us, that's an exit with a loss. And we know when it hits a Fibonacci extension, that is a preset price target that we can actually put alerts on our chart. So we don't have to watch it, and we don't have to watch the market all day long. Here's the walkthrough for this system. The first thing is we look for prices to move than the plus, the minus, one or two standard deviations. And the more you see different stocks, different ETFs, different Forex, you'll become aware that this one usually reacts to the plus or minus one, where this one reacts to the plus or minus two. And you can implement these in your trading. And that's another reason why it's good to have a pretty small market basket of stocks to really focus on when those trades can be made. Then the price makes a measured move and we are in. Once we're in, we let our profits run and use the Fibonacci price targets to preset, and we're ready to take profits at the 128, 162. Sometimes it'll have buying and selling pressure and it's just too great, and we just simply kill that trade when we have a measured move that goes against us. Now, it's very important to have an edge. Think in terms of a casino. A casino has an edge over the players. If you look at the roulette, for an example, there are 16 reds and 16 blacks, but there's a 0 and a double 0. This is the edge for the casino. In the long run, they cannot lose. They have a 5% edge. What we need to do is establish that edge in our trading. The edge number one is entering trades when the price is either overbought or oversold. With the regression channel, it statistically shows us when the price is ready to revert back to the mean, with 95% of all prices contained within the channel. That is the first edge we have working for us. The second hedge is occasionally there'll be outliers, so most times I'll wait for the price to change using a measured move. Edge number three is after a measured move, 68% of the time it reaches the 127.2% Fibonacci extension. Those are our edges. Now, it's very important to not overtrade in the market. As a matter of fact, when you're first starting out with a new strategy, a new system, I recommend people always paper trade. And paper trade long enough that you have some losers, you have some losing streaks. You've seen a lot of things in the market, and you're becoming very comfortable with the system, the strategy. And if you're making money with paper, then you can go ahead and put real money to work. I use these equations to kind of zero in on what trade size makes sense for a different portfolio. Now, here's an example of trading stock. As a professional, I never want to risk more than 1% of my portfolio per trade. Now, let's just assume we have $50,000 in our portfolio. 1% of that is $500. That is not what I want to trade. That's how much I want to risk. I know that in the long run, my average loss is only going to be at 25% of the amount invested. So the $500 divided by 25% means that I can make a trade for $2,000. If I have 20 equities in my portfolio, 20 trades times 2,000 is $4,000, $40,000, and that's well within my portfolio size. Now, you can take your portfolio. Let's say you're just starting out and you have $10,000. Put in $10,000 here, and you're just starting out and you say, I'm willing to risk 5%. Okay, and you can work your way down through here to come up with your proper trade size for your risk tolerance and what you're doing. Now, the example I'm showing you here is for trading stock, but you can use these equations to trade weekly options, monthly options, Forex, anything you're doing just by using these equations. You probably won't need 3 and 4 as much, but you can zero in on what a proper trade size would be for any portfolio size using equations 1 and 2. Now, calculating expected return is very important. This is one of the things that was taught to me by Dr. Van Tharp in a seminar I went to hear this. It made a big difference in my trading success. And basically what it is after you've been trading a while, you know how many winners you had, you know how many losers you had, you know how much you win when you do win, how much you lose when you lose. It's very important to keep these records. Once you have this, you can say, well, what's my expected return using this strategy on a going forward basis? Well, let's assume a trading account size of $10,000. And that means that I'm going to trade about $1,000, and that would be 4 TLT ETF credit spread contracts. Now, these trades yield 78. There's 78 trades for 21 months, or 45 per year. Okay, so that's the basis. Now, I use the expected return per trade equation, and that is the profitable percent times reward per trade minus the losing percent times risk divided by the trades. So in the above example, when we had this number of trades, we had 78.2% were winners, where 21.8% were losers. When I had a winner, I made $555. When I had a loser, I lost $497. That equates to making $326 per trade. I made 45 trades. My expected return per year is $14,670 on a portfolio size of 10,000. Using this strategy, using this expected return calculation, first of all, you need to be trading long enough to have statistically sound data. Once you have that data, you can plug it into these equations, and what you want is a positive expectation trading strategy. What we're talking about here is using the three simple principles, the regression channel, measure moves, and Fibonacci's, and these are actual examples from using that strategy, trading the ETF TLT. It is a positive expectation strategy. Now, one of the things that you can really learn from is to learn from people that are a success. And what I have here is a list of some concepts from master traders. I've pulled these concepts from things like Market Wizards by Jack Schweiger. I've pulled these from various sources. And what we want to do is we want to stand on the shoulders of these giants. And if they've done it and they've been a success before, why not just follow in their footsteps? The first concept is successful traders have virtually eliminated the effects of fear and recklessness from their trading. If we have principles and we stick by these principles and we know when we're going to exit and we know when we're going to enter, we have eliminated the fear and greed. Number two, traders' analytical tools are the known variables that put the odds of success or the edge for any given trade in the trader's favor. The three principles are my edge. They're now your edge. If you can learn to create a state of mind that is not affected by market behavior, the struggle will cease to exist. The market is a random walk. It just doesn't go straight up or straight down. It goes up in staircase and down in staircase. And unless you have a rock solid strategy, it's a very difficult market to make any sense out of, let alone successfully make money. When the internal struggle ends, everything becomes easy. It's almost like professional golfers. You see them swing, they swing so easy, but they have done that for thousands and thousands of golf balls. At the point you can take full advantage of all your skills, analytical or otherwise, to eventually realize your potential as a trader, the principles will disconnect you from the market behavior and allow you to not react on fear and greed, but allow you to react on statistical edge. I was just talking about a real professional spends a lot of time. The number one skill required that was common to all traders was a strong work ethic. There was a book written, it was called Outliers, and it talks about any professional who wants to become a success in their profession needs to be willing to put in about 10,000 hours of study and work. I have spent 35 plus years trading and honing these simple yet powerful principles, and you don't need anything more. Just follow what I do. Keep it simple. Step onto my shoulders, and I'll show you what to do. The next concept is the number one trading rule is the rule of limiting their losses when they had them. When a measured move goes against that trade, I'm out. I'm out. That limits my losses and lets my profits run. And I don't get out until a Fibonacci extension is reached. Do not enter into an invested position without an exit plan. And that is the 3 principles. And I got it. I got it. There is no need to be invested in the market at all times. Be patient and free to stand aside until matters clarify. Wait for price action to extend to outlier position. Regression channels overbought or oversold. Have a methodology. The simpler, the better. Gotta love it. We're using 3 principles that are good for any market. It can't be any more simpler. If you have a simple strategy, it then becomes easy to follow and easy to execute. Trading with an edge is what separates the professionals from the amateurs. Absolutely. That's why I trade with the principled method. And the edge is portfolio selection, entry signals, and exit signals. I use financially strong stocks in my portfolio, and I use a small market basket to really focus on when these signals can come to fruition using the 3 principles. The last part of part 1, we're going to talk about some real-time trades. The first one is looking at the SPX weekly. And for that, I look at the 10-day, 15-minute chart. And you'll see that down here, it came down to the -2 on the short-term regression channel. Came up and made a measured move right here. There's a measured move. At that point in time, I entered on Tuesday with this was the old terminology because this trade was back in 2016. But I wanted to show you this to show you that not only does it work today, it's been working for years. Okay, went in with a bull put down here. Got a $2.50 credit, and I exited when it hit the 161 right here with a 40-cent debit or an 85% return. Came down to the -2 on the regression channel, made a measured move, entered the trade, exited at the Fibonacci. 1, 2, 3. Here's a recent trade with stock. Entered the Google stock on Thursday, June 14th, June 14th of this year, which was right around here when it made a measured move. See, Google reacts a lot to the ±1 standard deviation. So when it came down here, I felt pretty good that this was going to be something that I needed to react to. And it did make a measured move. I was in. I got in at 11:58. I exited about a month and a half later when it came up here to the 127, and I exited at 12.78, which is a 10.3% return on a stock in a month and a half using these principles. Let's take a look at an ETF. Let's take a look at the SPY. The SPY. Now, this is an example of a losing position. And there are going to be losses. And we're going to take that loss when it reverts back and runs against us and makes a measured move against us. Here's a measured move up. Time to get into the SPY. The SPY at that point was 272.5. and then it looked like it was moving in the right direction. Then it had it went in the opposite direction, and here it made a measured move to the downside, which was a continuation of the measured moves up here. We got out at 269.2 for a 1.2% loss. Cut your losses short, let your profits run. Here's an example of Forex. When I teach, I only use the pairing the US dollar against the Japanese yen. There are many pairs. The four of the most popular are, of course, the US dollar, Japanese yen, the euro to the US dollar, the Aussie dollar to the US dollar, and the Great Britain pound to the US dollar. But here again, we're using the 10-day, 30-minute chart. You can see where here's the entry, here's a measured move, here's the 161 exit. Waiting till it comes up here, makes a measured move to the downside, captures the 261. What do you think we're going to do over here? Absolutely. We're waiting to buy on a measured move. Now with Forex, you can buy and sell. And most times these measured moves will result in about 100 pips in a day or two. Thank you for attending part 1. Can't wait to continue your learning for the masterclass in part 2. We'll talk to you then. Bye-bye.